Hey traders, Jason here from Leavitt Brothers. Happy Monday. Hope you had a good weekend. Hope your favorite team made the NCAA tournament. Mine did not. It's time for an update on my State of the Market series. The indexes are either pressing higher or holding their gains, depending on which one you look at. Both situations are pretty impressive given the rally off the December lows. You'd think that after such a big rally it'd be easy to actually have a legit correction, but so far prices are holding. The goal here is to look under the hood and see if there are any warnings. Okay, we had some warnings at the end of February and the beginning of March that I noted at Leavitt Brothers that led to a 5-day pullback. Now I want to check them out again. Are we getting similar warnings? What's going on? That's the goal here. Let's look under the hood and see what's happening. All right, so here's the daily S&P 500. How good this chart looks entirely depends on how far back you go. If you back it up 5 years, it looks great. If you back it up 1 year, you're thinking it looks okay because prices are basically unchanged going back a year. If you look at the last 5 months, you're like, hey, the market went down, it went straight up, so who knows? If you look at just the last couple of months, you think like, hey, we're in a nice steady uptrend. Okay, so I think the jury's out. Okay, the market since the December low has done really well, but if you back it up a couple months before that, then we're just simply unchanged over the course of 5-6 months. So highs are within reach. You know, volume looks decent. The trend looks good. We're above the 50 and 200-day moving averages. We're up against resistance. I think from here we could press higher and go to the highs. We could also dip back down 100 points and drop back into this range here. Okay, I don't think you could be overly bullish or overly bearish just looking at this chart. All right. One thing to note among the indexes is the movement of the NYSE and the Nasdaq. The market tends to do best when these two are on the same page. Okay, so if I go back to September, you had the NYSE making a new high, you had the Nasdaq making a lower high, the market dropped. After it dropped, you had the NYSE trying to make a higher high. The NAS had no part of it. The market dropped, and then a couple weeks later you had the NYSE making a higher low and the NAS making a lower high, and the market reversed. So whenever these are on the same page, the market tends to keep going in that direction. But whenever there's a divergence, and it doesn't matter who's leading or lagging, it's not that one always is in charge. Like whenever there's a difference between the two, the market tends to reverse. All right, so if I zoom in, as of this weekend, the NAS was making a higher high and the NYSE was actually making a lower high, or at least the same highs. Now today, the NYSE moved up a little bit and since has backed off. Okay, so you could say that, hey, it's been negated. I'm still going to note it because the NAS made such an obvious higher high and this one is just basically at its high. So it's still notable. Okay, if the market does better when these are on the same page, you can look at these two charts and say, hey, they're not 100% on the same page. So it's a little bit of a warning. All right, let's look at some breadth indicators. Okay, here is the S&P 500. The middle chart is the 10-day moving average of the AD line, and the bottom is the AD line. Okay, so the advanced decline line is at a new high. Okay, so that's very good. Overall, that's very good. It bodes well for the future, even if things backed off, and we got the line moved like this, but then there's a cushion to work with. There's a buffer to work with. Okay, it's done well enough that even if the market backed off for a few weeks and the AD line dropped, there's enough of a cushion to work with to believe that a pullback is just a pullback within an uptrend rather than the beginning of a downtrend. Okay, but we're getting a divergence with the 10-day. Okay, typically, divergences end up going in favor of the indicator. Okay, so the market moved up, higher high here in September, lower high here, and then of course the market dropped. You don't know how much it's going to drop. This is more of a short-term indicator that looks out a couple weeks. It doesn't look out months. The fact that the market dropped this much actually doesn't matter. But just the fact that the market was moving up to a new high and then the AD line was putting in a lower high and was actually close to zero was notable. We're getting the same thing right now. Okay, we got one, in February, caused a pullback here. It continued. We got a pullback here. Now the market's pressing to a higher high, and the 10-day of the 80 line is putting in an obvious lower high. and it's barely above zero, which means over the last 10 days, advancers are beating decliners, but they're not beating decliners by very much. Okay, and as you can see, because this entire line is moving down, you can make a case that as this move has matured, advancers are beating decliners by a smaller and smaller amount, and eventually that kind of internal pressure tends to lead to a bigger correction. Okay, it's something to watch out for. In order to negate this, we're going to want this line to move up and not lag so much and not be down by zero. Okay, situation at the NAS is very similar. I'm not going to talk about too much about this. We are getting a lower high over here, so while the NAS itself put in a higher high there, the AD line put in a lower high, and then over the last 10 days, decliners have actually beaten advancers. Okay, so think about how much sense that should make with the NAS moving up and up and up, and posting a higher high. Decliners have been beating advancers. Even if this line was above zero, you'd say, hey, decliners are beating, or advancers are beating decliners, but by a smaller and smaller rate as time goes on. So it's something to keep in mind. A little bit of a warning. Zooming in a little bit, here's the AD line of large caps, mid caps, small caps. Okay, so I noted this on Leavitt Brothers 2 weeks ago, that when the large cap AD line was making a higher high, the mid cap AD line was making a lower high, and the small cap AD line was making a lower high. I noted this in our reports at Leavitt Brothers at the end of February, and the market did indeed fall. The S&P dropped about 100 points over the course of a week. Then it bounced last week, but now we're getting another divergence because the AD line among the big caps continues to press up and made a higher high last week, but among the mid caps put in a lower high, and the small caps also put in a lower high. Okay, so it's something to look out for. A short-term divergence, short-term pullback. This is becoming a bigger divergence, so it could lead to an even bigger pullback if it doesn't kind of right itself pretty soon. All right, new highs, they seem to be in good shape. Okay, when the market trends up, you tend to get new highs that oscillate at a decent level. It doesn't have to be at a really high level. It just has to be at a decent, healthy level, and that's what we're getting right now. So I don't see any warnings here. I'd say overall this bodes well for the market longer term, that we're getting a steady print of new highs in a pretty good range. So longer term, this indicator tells us the market's in pretty decent shape. Okay, but if I zoom in with new highs among large caps, mid caps, small caps, we're getting a little bit of a different story. Okay, so if I go back to August, September, you can see new highs among the large caps stayed pretty strong. Little bit of a fall, but they stayed pretty strong. Among the mid caps, they stayed strong until like mid-September, and then they pulled back a bunch. You could see the size of these rectangles I'm drawing. And among the small caps, they just steadily trended down. So if I look today, I get new highs at a pretty good level. Among the large caps, I get new highs among the mid caps. They're steady, they're not falling off, but they're not quite as big as they were back here. And then the small caps are already starting to fall off. Okay, so this is the beginning signs of maybe some weakness seeping in. Now the weakness can be negated. We can get a big surge in new highs, and like we'd have to reset the clock at zero for these. But for now, what I'm seeing here is that if step one of the weakness is small cap new highs start to fall off, we're starting to see that. And if step two of a warning here is that new highs among the mid caps fall off, it hasn't happened, but mid caps new highs haven't been at the same level if I compare the top of that box to the top of this box. Okay, so a combination of a lack of new highs at the small caps, a lack of new highs. There's new highs at the mid caps, but they're not as strong as they were before. A little bit of weakness seeping in. Is it urgent? Does it mean the market has to fall right now? It's hard to say, but it's definitely notable, and if it's not negated, it definitely will bring the market down. Okay, I definitely think this is a warning to pay attention to. All right, here is the percentage of S&P stocks above at a 20-day high. Okay, and I'll start going through these a little bit quicker so I don't talk too much in this video. Okay, so the market's right here. Okay, black line, new highs, new 20-day highs were here. But when the market, a month later, when the market was up here, we had less stocks at new highs, not new highs, but at 20-day highs. And then as of like Friday, well, actually forget that. Let's if we go back to the end of February, market making a new high again, or at least a higher high, and now we have even less stocks. Okay, so if I connect all these dots, we got markets doing this, and the percentage of stocks at a 20-day high are doing this, and then of course it just collapsed over here. Okay, so now we got the market at another new high over here, and the percentage of stocks at 20-day high is much lower. Okay, it's something to pay attention to. Okay, as the market has gone up and up and up, less stocks are participating. Okay, this type of divergence doesn't have to resolve itself immediately, but usually if it persists for a couple weeks, it eventually brings the market down. Here's the S&P 500 and the percentage of stocks at it above their 20-day moving average. Okay, the last chart was above a 20-day high. Now we're above a 20-day moving average. What I want to point out here is, despite the fact that we're in a healthy range, okay, I want prints above 50%. That's characteristic of a strong market. I want to note the divergence that I see that's forming here. So if I go back to August, September, you have this divergence here, okay, and then even while the market was up here, you had the percentage of stocks above their 20-day moving average actually falling. Okay, so if I compare that to today, we're getting a pretty good print right now. I mean, 70% is fine. I don't think there's anything wrong with that, but it's a lot less than it was a couple weeks ago. Okay, so if this indicator falls off here while the market continues to press higher, that's going to be a big warning. Okay, that's what I'm looking for right now. I like the print here. 70% is perfectly fine with me, but if this thing doesn't improve, if we don't move up here, then we're going to get a warning, and I'm not going to predict that we're going to get another drop that's like as big as what happened in October, November, December, but we are going to get a bigger drop than what happened 2 weeks ago when the S&P only dropped 100 points. Okay, last chart. Similar situation, this one with the percentage of stocks above their 50-day moving average. Back here, August, September, we got a divergence and then a very quick drop. And you can see, like, right over here, 55% of stocks above their 50-day moving average, even though the market was still up at its high. It hadn't even, market was still pressing higher and holding its gains. Meanwhile, the number of stocks above their 50s were declining. Okay, so what I'm looking for right now is we have a divergence in place. I like the print here. 80% is perfectly fine with me. That's indicative of good participation. But we have a divergence in place, and if this starts to fall off, if prices start to tick higher here, maybe even flatten out, do something like this, but this indicator slowly moves down, we might get a repeat of here. Okay, again, not predicting this kind of a drop, but we are going to get a healthier drop than the 100 points that we got 2 weeks ago. Okay, so overall, I like what I see. Longer term, the market is in good shape, but shorter term, I see some warnings that either need to be negated by improvement or the market's going to correct again. Okay, thanks for listening. If you like the video, want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content when it's posted. Come check us out at Leavitt Brothers. If you're not getting the results you want, change something. Change the types of trades you do, change how you do your research, where you get your ideas from, try different things until you find something that works. Okay, check us out at Leavitt Brothers. Perhaps we can be the key ingredient that gets you over the top. Again, thanks for listening, and I'll see you next time.